It's Elaine, and this is episode 676 of the Orange Pill Investor. What's up, Data? Yeah, we finally got some relief. Um, I'm I'm trying not to jump into the "we're so back" camp yet. Um, I think with the conclusion of, well, at least the first leg of the spam war, I don't think I don't think the hard fork is particularly credible. It's not like anybody thinks, oh yeah, Blake 2B hard forks and like Bitcoin goes to fucking 30 and Blake 2B goes to 50 or 100. Like, I don't think anybody's expecting any kind of flippening. And even if I harbor some deep down revenge fantasy, if if Blake 2B ever overtook legacy Bitcoin, it would take 10, 20 fucking years for that to happen, I would think. That's how long that the legacy Bitcoin network has been growing. And so something, hard fork is just not going to flip that overnight. Especially, I messaged my buddy that got me into Bitcoin, and I was like, "Hey, man, I really, you know, I told him he was my Bitcoin John the Baptist because he's the one that got me into Bitcoin, and I was like, I'd like to hear your opinion on this Blake 2B stuff, and he hadn't even heard about it. Like, if you're not on social media, and who was it that said something? Can't remember if it was Joe. It might have been Ben Schmidt, but it was either Ben or Joe or Forrest, one of those fucking Canadians, and was just saying, look, we just live in an echo chamber on X, and there's a whole bunch of people out there that literally just are not paying attention to all the shit that we think is important, and I think that's probably true. Um, so on one hand, I was kind of ashamed of myself. I was like, damn, am I getting all worked up for nothing? But at the same time, I had to kind of reflect and like, I legit think all of the arguments for the BIP 110 fork are still undefeated. Like, the outcome was obviously not what I had predicted, but literally nobody still has an answer for any of that shit. But anyway, the market probably has figured out the spam war is over, and it's time to get a little pump. And I was a little bit worried that the outcome was priced in and we could even flash down from here. I think all the people that study the cyclic annual shit, somebody posted a chart the other day, and it showed a lot of red August and September before we get to, was it October? Was October usually decent? I can't remember if it was October, November, but I think historically August and September are generally not great. So are we, technically we're up. So we might actually have a green if we can hold on to this from there. Oh, I guess do have to hold on for 2 more weeks. We can hold on to a green August. I'm still a little bit worried that they'll drop the bottom out of everything. Stock market and Bitcoin. Maybe we'll start going hard in Iran again. Or hell, did we ever finish the job with China and the tariff talk? I thought that was supposed to be. I thought they kicked the can down the road and we're supposed to get some finality on that. So they can drum up any kind of scary bullshit to fucking rug us, right? So if you're using this as some kind of momentum trade and like, oh, we're so back and we're going to 80, 90, back to all-time highs, I'm personally not doing that until I see. I'm definitely not doing it after a pump. Now momentum traders can do this type of shit, but I never really learned that skill. I probably need to. What was the book that was recommended to me? Was it just called Momentum Trading, or was it shit? I can't remember now. Um, but yeah, I never really developed that skill. But it is definitely a welcome pump. And the title of the show, I finally got, I finally got green in every single account except for the IRA. And the IRA is still red, but I was taking a lot of risk with that one. Poor man's covered calls, tons of leverage, and with strategy being down, even on this pump, like it's up 15%, right? Basically overnight. Even on this pump, it's down 30% year to date. So the fact that my main account finally, I'm like, it's only $1,000 green, but the fact that strategy, which was the primary driver, is down 30% for the year, and I still managed to squeeze out a fucking break even. Uh, I'm pretty happy with. Now, what's Tesla year to date? Okay, so Tesla, I thought, well, maybe Tesla kept me afloat. So I had half the account in Tesla. I think they had basically the other half in strategy. They're both down 25, 30%, and I still managed to break even somehow. So uh, I'll pat myself on the back for that. Now the problem though is when you have limited upside, you're reducing your downside, which is great. But now what you'll see on a lot of these trades is that I have limited my upside, and I would actually be way more uppity overnight because all of my Strive shares are capped at 12 and a half, and I think it's up to like $14 a share now. And my strategy, my last remaining 100 shares of strategy, I still keep rolling out the 87 call. So that damn thing is severely underwater at this point. I don't know how long I can roll until you're right and keep that fucking thing alive. So that might be an exercise in futility. But yeah, it feels good. Appreciate that, Dana. Septober. What's up, 21st century? Good morning to you as well. So this is actually going to be a good episode for, especially for people either who are new to covered call selling, and this might be the first time in a year where your strikes have actually gotten wrecked and you're like in panic mode. The um the bad news is there's nothing you can do about it. The good news is since there's nothing you can do about it, you don't have to worry about it because you're locked into these contracts from when you open them. There's no way to really massage them. Your only choices are to just admit that you fucked up, pay to get out of it, and maybe wait for a better opportunity to re-enter that covered call. But so you can do that. You can just be like, you know what, sudden cover calls is not for me, or just not right now, and I'll wait for my positions to move like this move, and then I'll put them on afterwards. That's a viable strategy. You could try to play the roll into your right game, but even in that scenario, I try not to do it until I have to. Like this one, I have to. It expires today. I can't kick the can down the road any further. The delta is basically one. There's no extrinsic value in here. So I'm just gonna, oh, let me reshare without volume. Yeah, Dana, I felt like on a feel good day like today, a little feel good ink was appropriate. So if I just try to do the three expirations a week with Tesla, I can roll out. Now I'm only going to get a 52-cent credit here because this is still a 90 delta. This is 90% of this is well, that's not exactly what that means, but the majority of this is intrinsic value. If I prorate that $60 out for three expirations, that's 180 a week, which is like 0.5% of the underlying week. I mean, that's not terrible, but it's also not really what I'm looking for. So I'm probably going to have to roll this out much farther. I'm just, instead of getting the three a week, I'm probably just going to roll this out to 45 days. And I can't do a quick roll, so let me just go ahead and do it manual. So I got to buy back the 15. I'm going to go out to 44 days to expiration. And the highest strike that I can roll to and still and not have to pay a debit, I got to pay or get paid at least 1,500, which gets me to the 360 strike. This gives me like a tiny little bit of breathing room, but not if Tesla just runs. Now going back and looking at this, I got paid 1,500 bucks. I generally assume that I'll collect about 1/6 of that per week, approximately every 3 weeks at the latest, rolling it for 50% of the profit. So that's like 770 in three. Well, let me just divide by 6. So those were the 250 a week. That's about right. So 250 a week is a little bit better than the way I was trading it before. Maybe somewhere between 0.5 and 0.75% of the underlying per week, and another 3% potential upside. So that works for me. Now the debit spreads that I had put on might be like, this one is basically break even, so I'm not going to mess with that one. These other positions. Oh, you know what? I don't have. All right, so I put on the put credit spreads 2 days ago. So let's see what these are worth. I sold them for $1.58. I can probably close them for some kind of profit here. Not a lot. When I say 158, so that's only about 10%, but that's in 2 days. Yeah, so this isn't a big enough move for me to necessarily take these off. But usually I like to put my close position at 50% profit on. So that way I don't even have to look at this. You already have a closing. Oh, that's right. I'm sorry. That's these. I thought this was a, since this working order wasn't below the put credit, I didn't realize I had already put that in. All right, so the call debit spreads that I put on 9 days ago, I paid $1.27 for those, and I could close them for like 10% profit. That's not really worth my time. And these are probably still down. Oh, those are worthless. These got to be even more worthless. Hmm. So I did hedge out. Wait, is that what this is? Wait, that's a oh, I had formed a synthetic. All right. The a synthetic is a short put and a long call. So the short put and the long call. And then I went ahead and bought a 350 put and sold a call at 350. So I sold this bad boy for 14 grand and I could buy it back for 6. That was 100 days ago. If I do that, it frees up this long call at the 400 strike. Now that's only about a 47 delta. But if we do run and Tesla goes above 400, I could turn this into a poor man's covered call. Do I want to do that? I would probably just leave the put credit spread hedged out. Huh. You know what? Let me deal with Strive first because I'm getting wrecked on all of my covered calls. So I'll probably have to right size those. And then if I've got some money left over, maybe I'll come back and buy this short call back. SpaceX is just doing its thing. Plenty of extrinsic value there. No reason to touch it now. Strategy. I had already rolled this out a week ago, but it's getting worse. So we'll see what happens. Unfortunately, I tried to get a little too cute adding these long calls to protect my 100 shares with. I had said yesterday that you probably need somewhere between 20 and 40 shares per 100 to kind of insure them against a move like this. But I didn't want to buy these calls at full price, but it turns out full price would have been a discount because I was trying to buy them. I think the price was 180 and I was trying to buy them for 125. Now they're already up $1 per contract versus what I could have gotten them for yesterday. So unless the bottom really does drop back out of Bitcoin, these aren't going to fill, unfortunately. Which isn't the end of the world, but it's also not optimal. All right, so with ASST, I sold the 12 and a halves. There's like no extrinsic value here because this 500 is divided by 50 because I have 50 contracts. So there's like $10 of extrinsic value. Actually, that's not even terrible. $10 per contract is almost 1%, is like what, 2/3% of the underlying. Maybe I don't have to deal with these today after all. They're 0.88 delta. If these were like 95 delta, I guess I would have to take these off. But I guess I don't have to. I kind of assumed I would need to. Um, The cash secured puts have only been open for 2 days. I could keep 25% of what I sold them for in 2 days. That would give me enough buying power to buy the Tesla call back. So maybe I'll at least do this. So on this pump, I reduced my long exposure a little bit and booked those quick profits. I guess I don't have to deal with this today. Maybe I'll kick the can down the road at least one more day. We'll see. Now, if I did want to keep as many of these shares as possible, and I wasn't trading on a margin account, or I just wanted to not dip into margin, the whole point of adding these long calls 9 days, or call debit spreads 9 days ago, let's see, the price on these is $12.74, and I can close them. Whoop. At any rate, oh, because I bought one extra call, so there's an extra call screwing up the price. All right, so if the trade price is $12.74, let's just close the whole thing. I could make $300 per contract. No. Yeah, I screw up the ratio here. So I've got 20 call debit spreads, but then I bought one extra call, which is now I can't figure out how much I'm making off of each of these. Maybe I should just sell the extra call that I bought, and I'll get this back to. I mean, that's what buying the calls are for, right? When the thing pumps. So let me just do one. You take some profits. All right, so I bought that call for $300. I'm trying to sell it for 410. Keep the $100 profit. All right, now I've got an equal number. Okay, that works a lot better. So now this is accurately reflecting my trade price of 50 cents, and if I close them, I can make 10%. That's not really enough for me to bother with. But the point is, they are 100 delta. So if I need 20 per share, this is ensuring about 500 of my 5,000 shares. So this is not nearly enough to ensure 100% of these 100% of these shares. But if I did need to, pay to roll a couple of these, I could peel these off and sell them for profit. But for sure, this account is highly underinsured. And I'll probably continue to do that through September, and then maybe, well, until we get some kind of meaningful dip between now and October. I might use something along those lines to justify adding a ton of cheap leverage. All right, so I took off some of that long, and with Tesla, maybe I will unhedge out this short position, because I sold it for 14 grand. I can buy it back for 6 and keep the 8. So I made 8 grand in 100 days with that. Or I saved myself from losing 8 grand because because this long call, if I had just left it there, would have depreciated from 9 grand to 4,500. So I will close this bad boy. So let me ungroup this now, because now I have a vertical. So I sold the 400 and bought the 350, but at different times, right? Because this is, yeah, this is weird. Let me go put this. So this is June 17th. Sell the 400, buy the 350. If I did this today, so this is selling a put credit spread. Is that right? I hate the charting function on Tasty Trade. I should probably spend some more time looking at it. Oh, that's not what I meant to do. I've never looked at that before. This would be risking 5 grand if I put this on today. I'm just trying to get a feel for what I have on. I put them on at 2 different times, so the entry prices are a lot different. But if I were to sell the 400 and buy the 350 today, I'd be betting that the price goes above 350. Is that right? Let me put this in. The graphs are way more 80 IQ on Robinhood. All right, so June 17th, 300 days. If I sell the 400 and buy the 350, I guess what's confuses me is I never buy these at the money or sell them at the money. Wait, estimated credit 13 grand. Do I have a... This doesn't work. Oh, I tried to sell two. I put. Okay, yeah. So put credit spread, break even price. So if we go above 400, then I would keep it all. Yeah. So I would never sell a put credit spread this far out. The only reason I did this was to hedge out the position. So I hate this from a theta decay standpoint. But the current prices are 85 and 54. And the one that I sold is basically the same. But the one that I bought, why does it say my trade price is negative? That seems impossible for a long put. All right, so if I do want to take this off, that would cost me another 3, but it would release 1600 in buying power. Yeah, it's not really worth it either. Yeah, there's no reason for me to even bother with this thing at this point. But now I have a long call. So let's group this by itself. And if this pumps to like 425, I could probably turn this into a poor man's covered call if I didn't want to just take profits on it. All right, 21st Century says, I'll have to read your pinned tweet about options trading. Don't know anything about it as I trade indices futures. That sounds scary. SpaceX I'll buy whenever either 80, 90 or after December last unlock. Oh, so if it dumps to 80 or 90, there's some decent support at 100. For me, Tesla made its low 2026. From now on, it's up only. Target 650. I'll take it. All right, so with me unlocking this long call, now I have 178 net delta, so that's plenty of insurance. Like there's no scenario where I wouldn't be able to peel off uh, the credit spreads or the debit spreads or the long call to make sure that I don't lose this position. All right, I still, oh, I didn't deal with strategies just hanging out. Yeah, I didn't need to actually deal with this. So I will kick the can down the road till at least tomorrow. There was just enough extrinsic value here to leave this on. Tesla, same predicament. I already rolled this out. So every 3-4 weeks, I'll have to continue to do that. Maybe try to roll up and catch the price. Plenty of extrinsic value on the SpaceX cash secured put. No reason to deal with it early. ASST, again, I've got just enough extrinsic value here to justify keeping these on another day. But if this bumps up to like 95 delta, then it'll be time to move on. The $15 covered calls, 15 strike, um, the price is going in the wrong direction, but they're not quite in the money yet. So nothing to do but sit and hodl there. I could take a quick profit here. I bought it for 250. I could sell it for 350 and keep the $100. But what would that be? About a 40% profit. I should probably be tempted into doing that. But I also don't want to pay the taxes on it yet. So I'd probably end up hedging this out again. So yeah, I guess I thought I was going to be needing to make some moves, but don't really need to. It's a significant move, but there's still enough extrinsic value for me to chillax. All right, Strive, similar situation. There's just enough extrinsic value here for me to do nothing until tomorrow. And I could, if I just close this thing, what would that get me? Nothing. So I can ignore this long call that's hedged out for the most part. So I'll probably end up trimming this by at least one position, maybe trim it down to 500 shares, roll the rest out, and reduce my long exposure. I may straight up run the wheel and just turn these back into cash secured puts. So if I sell one of these, I'd get a $1,200 credit and I'd get $731 of option buying power back. And then I would probably turn that into like selling a $12 cash secured put out 45 days. If Bitcoin reverses, strategy dumps back down to 12 or below, at least this would be giving me a good discount. The other option is to just continually hammer aggressive covered calls. Like if I was putting on an at the money covered call today and selling the 15, that's like 4% of the underlying price for half a trading week. The premiums are pretty insane here, but they're justified because if you get paid $60 for half a trading week, that's not going to save you if Strive drops to 10 or 8, which it can do. The other thing that I could do is peel off 100 shares and then put that $1,000 into SATA and wait for a potential dip. So not really as much maintenance as I thought I was going to have to do. Now this one, I didn't deal with these ASST cash secured puts yesterday because they still had some meat on the bone. But now with 3 cents for half a trading week, there's no reason for me to keep these on. So I'm just going to buy all 5 of them. And that's going to give me 6 grand of option buying power back. Let's see, 21st says, for instance, I guess knowing options would be better in the sense, if I'm correct, that Tesla made its low, so buying a Tesla call would be the correct move. I don't know how it compares to futures, but let me see what you said here. Let's see. For example, what would you, in this case, if you did think Tesla made the low, which call would you buy and why? So I'll start by answering that question because I started out trading as an option seller. And so I'll answer this question in reverse because if you're an option seller, you want to extract theta decay and premium under 60 days to expiration. The theta decay curve really starts to accelerate maximally, according to Tasty Trades research, at 45 days to expiration. So I would go anywhere between 37 and 52, somewhere in that range, and sell something out of the money. Doesn't really matter which delta, 10, 20, 30, whatever, as long as it's out of the money. And what I would do is, every 2 to 3 weeks, I would just sell it for whatever and try to buy it back for half price, sell it for full price again, and just do that every 2 to 3 weeks. And so if under 60 days is the sweet spot for selling options, then that means I'm profiting off of the call buyers under 60 days. So so as a buyer, I want to reverse that thinking and get as far away from 0 to 60 as possible. And buying calls greater than a year out are called leaps, long-term long-term expiration anticipatory securities. I think that's what that stands for. And the beauty of going out 365 is, number one, if you can hold the damn thing for 365 days, you can take your profits and pay long-term capital gains taxes. So this 394 would be fine, except that I don't really like to hold long calls under 90 days, so I'll probably take 365 plus 90, and I would probably want to buy something at least this far out. This gets me as far away as possible from the people selling options and profiting off the call buyers. The farther out you can go, probably the better, because they decay slower. But the farther out you go, the more expensive they're going to be as well, right? So if I just wanted to buy a call speculating that the price would go up, there's two ways that I think about this. One is getting the cheapest delta per dollar, meaning like one delta is equivalent to one share of the stock, like one share of price action. So I like to think of what calls can I buy to get the cheapest delta per dollar, right? You want the cheapest cheapest gas, right? Cheapest $4 a gallon, whatever. So I want the cheapest price on the most number of delta that I can get. And that's all the way at the top of the chain. And this is called attacking the tail. So if you look at how much delta you can get up here, you can get 10 delta for 800 bucks. To buy 10 shares of the stock would cost you $3,460. But you can get exposure to 10 shares for 800 bucks. So as a pure delta per dollar play, I always just go to the top of the chain and get as cheap as possible. Now, the other thing that has to be paid attention to is this gamma number, because every dollar that the price of the stock goes up, so if Tesla goes up from 346 to 347, then this delta is going to increase by the gamma number. And then gamma will also change because, as we see, gamma's 0.001 instead of 0.0008. So gamma is also going to continue to increase, right? And so what did you say your price that you thought Tesla would hit? Target of 650, but you didn't say by when. But if Tesla goes up $300, this this position would go up 300 times zero point 0.1. So this option price would go up 30. So you'd buy it for $800 and it would be worth $3,800 in that scenario. It would probably be up a little bit more because every dollar that it goes up, it's also going, like, delta is going to increase by this. So let's look at, you said $300 a share increase. So let's look at the 690. Now the delta, if the price goes up 300 a share, the delta on this would be actually 0.21. So the delta would be double the delta that you were getting at whatever it was, the 990 strike. And gamma has also increased. So all the way at the top of the chain is where you can get the cheapest delta per dollar. But the other way to think about this is, I mentioned that the optimal theta decay curve is under 60 days to expiration, but the optimal gamma curve, which is going to give you the biggest increases to your delta, is approximately like 20% out of the money. And it would probably end up being, well, not necessarily 20% out of the money, but gamma is maximalized at 50 delta. So that's right about here. So this is about as big as gamma is going to get. Let's just see if that's true. 20, 20, 20, 20, 20. Okay, at some point it should be starting to decrease. Okay, 19, right? And then let's go in the other direction. This was 50. Yeah, and it starts to go down again. So if you had already invested in a call, you could sell it when gamma was at its max, which is going to be when the delta is at 50. You're going to get increasing returns as delta goes from the 0.1 all the way at the top of the chain until it gets to 0.5. So in this sense, if I really wanted to ride the gamma curve, I would probably buy the 40 deltas. And then, and I'll give you another resource that you can check all of these things to yourself and compare apples to apples and oranges to oranges. So let's think about this for a second. If I buy this one, I can get 40 delta for 4,200. The other price was what, 845. So multiply that times 4, that's 4160. No, it's actually very similar prices. Is that right? Yeah, I can get 0.1 delta for 845 times 4. Hmm. Yeah, I definitely like this one better because I can, unless the bid-ask spreads are jacked up. No, this should fill. Oh, no, I'm sorry. I can't do math. So in order to get 40 delta exposure with the 990s, I had to get 4 of these, which is 32 plus 160, 3360. Okay. So it would cost me $3,360 to get 40 delta with the 990s, and it would cost me $4,200 to get 40 delta at the 500. But this is the point where gamma is at its peak, meaning you'll get faster delta appreciation here than the 990s. So if you want to go delta per dollar cheapness, it's at the top of the chain. But if you want to be closer to the gamma curve, maximizing itself out, then buying something around 40 delta makes sense. You'll notice that these decay slower as well. So let's see, theta is 0.0897, whereas at the top of the chain, what the hell was it? 0.00434. Yeah. Okay. So this is a little bit deceiving. So theta on this is double. So it's the amount that this is decaying is twice as much, but relative to the price of the option, it's not, because this is 5 times as expensive, but theta is only twice as high. So you have to look at the relative theta value, not necessarily just the number, because this option is decaying by 8 cents a day, and the other option is decaying by 4 cents a day. But 4 cents is a lot larger compared to $8 than 8 cents is to $4,000. So you really have to hit on those 990s relatively quickly to make them pay off. The other risk is that if Tesla were to run to 650 in like the next 60 days, if you don't hurry up and sell that for a profit, and then it stays at 660 for the rest of the year, then you lose the entire amount, right? But in your scenario, hypothetically, if you're saying in a year we'll be at 660 and you buy the 500s, then you'd make 16 grand on this, because it would be worth 660 at expiration. That's $160 per share times 100. So you'd make 16 grand minus the 4 you paid for it. You'd make 12 grand if your price works out in a year. But if you can afford more time and you don't mind just going out all the way, give yourself a shitload of time to be right, then you could go all the way out here. And let's see, what's the cheapest one you can get? So out here, you can't even get 10 deltas. So you could get 24 deltas for 2,900, or you could get, we'll say that's 40 delta. You can get 40 delta for 5 grand. So those are the two theories that I work with. I either want the cheapest delta for dollar at the top of the chain, but then I have to be very careful to sell after whatever I think the rally amounts to, or grab something around the 40 delta that decays slower somewhere in here. It decays slower, and it going in the money and actually expiring with some value is much more likely. And you're riding up the gamma curve. And if I was going to be doing something like this, then I would probably sell it once it got to 60 delta. So I'd be looking to buy at 40 and sell it at 60, because 60 deltas down here gamma is still pretty high. But as it continues to get farther and farther in the money, this gamma number is going to start decreasing again. It decreased as we got to the top of the chain. It reached its max when we got to 50 delta, and now it's going to have diminishing returns as we get to the other side. The gamma is almost zero down here now as delta approaches 1. So just to sum that up, when I'm buying long calls, I do it exactly the opposite that I would when I'm selling them. I want to go as far away from short dated expirations as possible, preferably at least 1 year away. That's got optimal theta decay. It gives you a little bit decent amount of time to be right. Sets you up for paying long-term capital gains taxes. And then I did hear some rumors that the capital gains taxes might be changing, so I don't know if that's a big concern. And I'm not a financial advisor, so I can't actually give financial advice, nor can I give tax advice. But I want as long of a time frame as I can afford, and I will either just attack the tail all the way at the top of the chain or grab some 40 deltas and ride the gamma curve. And then each of them has their own profit taking, right? So if you thought Tesla was going to cap out at 360, then maybe when Tesla gets to 360, you sell this for whatever you can get for it. And then with the 40 deltas, I'd be selling them when they got around the 60 deltas, or developing some kind of exit strategy. Like if I was going to buy 10 of these or something, you know, sell 5 at 60 delta and sell 3 more at 65 or 70, you know, whatever. Come up with some kind of exit strategy. 24 says, thank you. Way more complex than I thought. Hello. Yeah. Yeah. It's, the 80 IQ version is just buy something at least a year out, and then if the stock price pumps and you can sell it for a profit, you can just do that. But, you know, really optimizing for how much delta exposure you can get or optimizing for how much gamma exposure you can get is two different theories. All right, what the hell was I doing? Did I finish this? Yeah, I don't need to deal with that. So the 5K account. Oh yeah, that's what I did. I gave myself this is hilarious. So this account is worth 6 grand, and Robinhood's margin calculations are so full of shit. Right now they're telling me I have $25,000 of buying power. That's so fucking dumb. There's no way they would let me buy 25 grand worth of fucking assets. Um, and even if they did, I'd be a fool to YOLO that hard. With like, I would just get liquidated, margin called so fucking fast. Anything goes down 10%, I just get completely wrecked. So I'm gonna pretend that this buying power number isn't true because it because it isn't. Like this is closer to how much actual buying power I have is this cash number. If you don't want to get into trouble, you can just turn margin off and not have to worry about that, keeping track of that shit. But I closed my cash secured puts because there wasn't a lot of premium left to collect. So now I have to decide, do I want to roll those ASST cash secured puts up for a credit, which, you know, puts me at we topped out at 1476 here. So we're down 50 cents. I could, I could sell the 14s. Half a trading week, I'd collect $30 on a $1,400 position. That's 3% of the underlying price in half a trading week. So that's pretty solid premiums. But since I've got 6 grand, I can't do 5 contracts like I had before. I can only afford 4 with some left over, right? That'd be 5,600. So I'll do that. And now you'll see my buying power drop precipitously. Even though I only spent 5,600 bucks, that 25 grand in buying power is going to drop to like 2 grand. Okay, 3. I don't know how Robinhood calculates this shit, but it's really funny to me. All right, so my options collateral is 5,600. I've got 6,100 in cash. So I have to subtract those two numbers. That's how much cash I actually have. So I have $524 in cash. I could go and get another 500 bucks if I sell my SATA. So that would get me to what, 1,024. That's just enough if I wanted to like sell the $10 strike 45 days out. But maybe I'll just buy 5 more shares of SATA. And then once this number gets high enough to sell another cash secured put, then I'll sell the SATA. 5 shares. Cha-ching. So yes, I increased my exposure by rolling the cash secured puts up to 14, but then I reduced my exposure even more by only doing 4 contracts instead of 5. So now I have $25 in buying power. I've got 10 shares of SATA. If Strive drops down to $10 a share, I could turn around and sell a cash secured put at the 10 strike, cash in my SATA. And I'll be getting like a nickel per share per day. All right, I think that's it. Enjoy the pumpy days when you can. And I think that's it. Appreciate everybody for tuning in. Be good, y'all.